Hello and welcome to Market Domination, sponsored by KC Trade. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
They talk about their engagement being up, but it was up only 1%. And so the question is they're spending a lot of money on content, but they're not getting the response function in terms of deeper engagement. And so it's really not a question of how much do they have to spend. I think it's more a function of, are they spending on the right things?
Going forward, I think it's Donald Trump who does pose quite a risk to the economy. If he follows through on his across-the-board tariffs, he's talked about 10%. He got criticism. He changed it to 20. Recently mentioned 50. That just would unleash a trade war, shrink exports, shrink imports, raise prices, lower jobs. Terrible idea.
We made a call earlier this year that NVIDIA would be the most valuable company in the world. It achieved that milestone yesterday. And the demand for GPU chips is strong. And you're seeing enterprises start to get some ROI on it from the early adopters. Meta seeing ROI on their CapEx spend. So we think NVIDIA's got plenty of room to grow from here.
We got 1 hour to go until the market closes, and we're taking a look at the major averages here. Not seeing much action in the Dow, but any gain today will be a record close for the Dow Jones Industrial Average. Right now, it's 31 points. The S&P 500 has been rising. The weekly move is what we're focused on here because it is the sixth straight weekly gain for the S&P, the longest streak we've seen this year. And the Nasdaq gaining today, not near a record. It is up on the week, though, and gaining as well, leading the gains, in fact, in today's session.
Yeah, earnings season. I mean, obviously, as always, some different data points and signals, but generally, you'd say decent, right? I mean, you're off to early innings here, of course, but some names today we'd call out. For example, I mean, Netflix, Julie, is having a big run. Let's see if we can find that. NFLX, look at it, 11%. That's what a beat and raise looks like. Analysts liked the operating margins. They like the outlook. I saw one analyst saying virtually insurmountable lead in the streaming wars, in his opinion. And that, I mean, look at that move. Obviously, some investors agree with it, at least today.
I mean, we talked to Geetha Raghunathan from Bloomberg Intelligence late yesterday after the numbers came out. She said the streaming war's over. Netflix won the war, right? So I guess it's just competition for scraps that Netflix has left over at this point. So definitely watching that. We're seeing Magnificent Seven strength, pretty
I call it Apple, too.
You can touch it. It'll come up.
I don't even want to mess with you. This is your board. That one, obviously, you got some, fairly bullish data points from a research firm, just kind of tracking iPhone sales in China. We have a guest, of course, we'll talk a lot more about these names with.
Yeah, let's do it now.
Right now?
Let's do it up.
Let's get right to it. Earnings season in full swing, and the race to a $4 trillion market cap is on between NVIDIA, Apple, and Microsoft. For more on what could drive these stocks higher, I want to welcome in now Dan Ives, Wedbush Securities Managing Director and Senior Equity Analyst. Dan, always good to see you and have you on the show. Let's start maybe just high level here, Dan. Big tech earnings are on deck. What are you going to be watching for and listing for? What are your expectations, Dan?
I'd say get the popcorn out, because in terms of what we're expecting for earnings, it's going to be a robust tech earnings season. I mean, Netflix clearly kicked it off, but in terms of AI demand, consumption increase, I think hyperscalers are going to have massive numbers. Microsoft, Google, Amazon, rest of software, we think tracking well ahead. And then even you look at internet and some of the consumer sort of tech names. In my opinion, this is now the drive toward 20K on NASDAQ. That's where I think we go.
Dan, when we talk about what we're going to hear from the hyperscalers during the season, though, how much of a problem is the spending side of the equation going to be, right? Because that's been an obstacle in the past. Yes, investors want them to be spending on AI, but are they going to be able to thread the needle in terms of how much they're spending versus how much they're earning?
Yeah, Julie, it's a great question. I think right now, investors, they're very comfortable with this $1 trillion of AI CapEx, where the spending is. Use cases are now starting to pop out. Of course, the Messi of AI, Palantir front and center in terms of that discussion. And I think now what we're going to start to see, the monetization, the second, third, fourth derivatives of AI now starting to play out. And that's why I still believe in this AI party. It's 9 p.m., maybe 9:30 p.m. and a party that goes to 4 a.m.
Just on that point, though, Dan, let me just push back on one. Dan Gallagher over at the Journal, smart guy. Here's what he says about that kind of mega AI trend, Dan. He quotes Morgan Stanley and the team over there saying, few Gen AI adoption projects have yet moved from proof of concept to production. And so Gallagher concluding, it remains to be seen if big tech's AI investments will be a gold mine or a money pit. To that statement, Dan, you say what?
I think there's no Tom Hanks situation in Money Pit here, because I kind of disagree with that assertion. I mean, Gallagher's obviously great, but I think what we're actually seeing is the opposite. Use cases are exploding. That's why we're seeing spending and the use cases continuing to actually incrementally increase. And I think 2025 is all going to be about the use cases on the enterprise side. So those that are saying the Money Pit, I mean, I've done 2 Asia trips the last 7 weeks. You come back saying this is gold mine, nowhere near a money pit. But that's why, look, what makes the market, the bears and the bulls, bears will continue to make people nervous here. But I think ultimately the bulls are going to win this market.
The gold mine versus the money pit. That'll be the title of the debate that we'll do, I guess, between you guys, Dan. You talked about the enterprise opportunity here, but I think we also have to talk about the consumer opportunity. And for that, you really zeroed in on Apple. And it seems like we keep getting sort of mostly negative data points on early sales of the iPhone 16. What convinces you that the release of Apple Intelligence is going to change that calculus?
Yeah, and first off, Joe, I mean, I disagree with the negative data point. Now, again, I understand if you've been bearish on this from $1 trillion to $3.5 trillion, I get why you'd want to be negative going into iPhone 16, but I don't see it. I think it's actually tracking ahead. It was all built. This AI-driven super cycle that starts with iPhone 16 is going to start in the December quarter as more Apple Intelligence get rolled out. We think 20% of the world's population will access AI through Apple, through an Apple device. And this is something, as this all plays out in the next 3 to 6 months, I believe this will be a historical year for iPhone units above 240 million. And that's why, with that counterpoint research today in terms of China, I mean, look, the bears are pretty silent today. I'm not hearing any of them, but I think that just speaks to our checks. China's going to show a huge rebound.
Do you think, Dan, though, with those AI features, though, from Apple, it's more of this staggered rollout, right, taking place over months? Do you think it's possible that actually, to the extent that there's a meaningful iPhone upgrade cycle, it's more of a 2026 trend than a 2025?
Yeah, and look, and Josh, you know Apple as well as anyone, and I think what we see from a supply chain perspective, we're talking 90 million units coming out of the gate. That was 82 to 83 million. Units have actually stayed the same. So what we see right now is actually this is going to be a 2025 event. Now, you could argue it's a multi-year super cycle as it all plays out, but you have 300 million iPhones that haven't upgraded in 4+ years. You have a pent-up upgrade opportunity that's unprecedented. And that's why I think we're looking, the first to hit 4 trillion will be Cook and Cupertino, followed by Godfather of AI, Jensen, NVIDIA, and then Microsoft in mid-2025.
Dan, I know we always like to talk about the market cap race. Why does it matter?
I think the reason it matters, it symbolizes just how the strong continue to get stronger. We're talking about 4 trillion today. You go back 2 years ago, people would say 3 trillion was never going to happen. And I think eventually we're going to be talking about 5 trillion because tech's going to become a bigger and bigger piece of the S&P. I think if you look at growth, we are in the midst of what I view as a once in a 40-year cycle. And I think that's why it's important. It speaks to just how strong the stronger you're getting in terms of big tech. And it's really numbers driven. And I think that's why it's so important once I think Apple breaks that $4 trillion mark.
Dan, I want to switch gears. Let's talk Tesla as well. Obviously, listen, they had the robo-taxi day. Investors perhaps, underwhelmed by that. Do you think that was because they got a lack of details hard details they could work with? Was it because I know maybe there's some chatter that hear more about this relatively lower price vehicle? What did you make of the event? What did you make of the reaction?
Yeah, I mean, I came away in 25 years covering tech. I think one of the most eye-popping historical events I've ever attended.
Wait,
right?
Dan, can I back up for a second? Because like I was looking at your note in the aftermath of this. I think you were the only one. Like honestly, and even the other fellow Tesla bulls who love the company were like, everything there, for lack of a better word, was fake. Like. That's not the actual van that's going to be on the road. The robots were remote controlled. Like, Dan, I always appreciate your optimism on these things, but like, were you at the same event that everybody else was at?
Yeah, but I'd say the same thing, like going back to iPhone launch in 07, going back to other launch. I've been at Microsoft, NVIDIA. A lot of analysts, if it's not spoon-fed to you, they're bears. They don't understand. The point is, like, if I look at Cybercab, the autonomous future, and where this is all going, I mean, I think this is going to really be the start of a whole new company at Tesla. And I think that's why it's one. I get the lack of details and why people walk away wanting more. But I just have a different take in terms of my view of where things are heading. And I think the way so many analysts have missed a lot of these stocks going from 1 trillion to 2 trillion to 3 trillion, I think to 4 trillion, is that they can find the technology in their spreadsheets or 10th floor of the New York City office building.
Dan, final name, I want your take on Amazon. Those earnings, of course, are also on the way. You note, listen, shares have underperformed since Q2. Why have they underperformed, Dan, and why do you stick with an outperform?
Yeah, I think, Josh, the reason it's outperformed, because I think the reason it's really underperformed the market and tech is because they view them as a third player in AI. The AI strategy has really been non-existent. I think Jassy right now is about to get into a huge period of growth. I think the consumer business is actually stable to actually increasing from a numbers perspective. Advertising street's given no love in terms of where this. So I actually think risk reward, the two most compelling relative to where they play in large cap, mispriced into numbers. I think it's Google and Amazon.
Dan, good to see you. Have a great weekend.
Great to see you. Thanks.
We're just getting started here on Market Domination. Coming up, a CEO shakeup has CVS shares sinking today. We'll speak to an analyst about what the move means on the other side. And at 3:30, latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stick around, much more Market Domination still to come. An executive shakeup has come for CVS, the company announcing it's replaced CEO Karen Lynch with longtime pharmacy benefits executive David Joyner. The shares have been sinking today following that news. For more on what this means for CVS moving forward, we want to welcome in Stephanie Davis, Barclays Senior Research Analyst and Managing Director of Healthcare. Stephanie, do you think that David Joyner is the right choice to take over as head of CVS?
You know, I think the decision to put David Joyner in as CEO is probably the right one and the best one they can make right now. David has turnaround experience. He has a very straightforward pull no punches style that we saw in his internal memo to the company today. I think all of that is indicative of the directness that we're going to expect out of him and something that CVS really needs as they go into this next era.
So, Stephanie, what should be Joyner's priorities?
I mean, the biggest question right now is who's going to lead Aetna, right? You had Karen Lynch out today. You have Brian Kane out last quarter. That leaves a pretty significant vacuum in a seat for Aetna, which is the entirety of what's been driving the downside for the past few quarters. I think we'll see an announcement soon. David Joyner has said that we're going to be getting a new Aetna head by year end. It cannot come soon enough.
Stephanie, you know, it's interesting that you talk about that he's the right guy to lead the company here. I think it's interesting his background is also from the pharmacy benefits management business. That, at least politically, that business has been, not just at CVS, but sort of across the industry, under a lot of scrutiny. And obviously the shares are going down today as well. So, you know, what do you think are maybe the things he needs to work on here, or why maybe the street is questioning this choice?
So I don't think they're questioning the choice. The stock has had such a pullback because of the scale of the guidance cut that they had, right? You saw very negative results out of the Aetna side of the business. That's not really something that you're going to be able to fix in a near-term fashion. But I wouldn't read into his background at PBMs as saying, oh my gosh, CVS is leaning into the PBM business. Instead, it's someone who is a proven executive who has been with the organization for a very long time, who has done a turnaround and will do a very good job of it, given his past history. I also think, you know, be remiss not to mention what CVS has done with its PBM, much more creative and much more consumer facing. Think about cost vantage. That couldn't happen, that level of consumer price transparency, without someone really taking a crucial look at the PBM.
Stephanie, let's get your take on Karen Lynch. I'm interested to get your take there. What, in your opinion, did she get wrong?
I think it's just there were a number of missteps this year, right? The leadership change doesn't come as a huge surprise to myself, or I think for many investors in the community, just because there has been, I think, 4 guidance cuts year to date. And so it's not a question of really how they're able to execute so far. Some of it's more on the question of execution specifically in Aetna, which is what they got wrong. For what it's worth, the retail pharmacy and the PBM have done quite well this year.
Well, and I was going to say, it sounds like also the company has pushed back against the idea that it might split itself up. Do you think that's the right choice? Do you think CVS is stronger and being valued correctly as that combined business?
So we're overweight in the stock, and that is because I do not think it is being valued correctly, but I don't think a sum of the parts is the right way to approach it, right? A potential breakup seems highly unlikely, not only because the amount of dyssynergies you would create. Don't forget, CVS saw $750 million in cost synergies from Aetna alone. They saw $500 million when they bought Caremark. So there's a lot of value in combining these assets together. But more than that, you can do very strategic things by having a PBM, a payer, and a retail pharmacy together. What I mentioned about cost vantage before, that wouldn't be possible without having all of these 3 assets kind of working in tandem.
Stephanie, great to have you on the show today. Thanks so much for joining us.
Thank you for having me.
Workplace software company Okta is rolling out a new layer of security for consumers using generative AI agents in an effort to make the process more secure across applications. And joining us now to discuss is Todd McKinnon, Okta CEO. Todd, it is always great to see you. So you made a number of announcements, Todd, at your big customer conference. Walk us through the highlights.
Well, I think big picture, if you zoom out, the technology industry is spending billions and billions of dollars on cybersecurity tools, yet it seems like there are more security breaches than ever. And when you dig into the root cause behind them, over 80% of security breaches involve some kind of compromised identity. So all of our product announcements across the board, from workforce identity to customer identity, are all about stopping those breaches and how we can work together with the entire industry to do what we're all trying to do, which is have fewer breaches.
And also part of the announcements have to do with sort of standardization of identification across, when people are being authenticated via their various apps and work functions. Do you think all of this is going to boost your business, Todd? Give us some color around that.
It's a very important problem. In fact, it's the biggest problem in technology today, which is if you look at a company that has probably thousands of applications, not even a very large company has thousands of applications, they don't all work together in the sense of they don't all share complete information about the identity threats that are coming toward the applications, that are coming toward the infrastructure, and they're not good at sharing real-time risk signals and taking actions as those threats emerge. Someone compromises a user's email, and how do they use that to move laterally throughout the ecosystem and get to an administrator and cause something really bad to happen. So by working together as an entire industry and formally standardizing the interfaces on how these things should share security information, we think we can make the whole industry more secure and get back to what we're all trying to do, prevent security breaches. How many of these personal data privacy notifications have you received in your personal life? How many times have your credit cards been reset? Enough is enough. We have to stop this as an industry, and we think we have the right standardization process in place to do that.
Todd, some analysts I know who cover Okta, they bring up to their clients that they think Okta faces just this sort of broader challenge. And the way they frame it is that they say during COVID, many organizations just got too aggressive. They over-purchased seats from you all. And now what we're seeing is this real right-sizing taking place. One, Todd, do you agree with that dynamic? And two, if you do, how long do you think this sort of right-sizing impact goes on for?
If you think back to 4 years ago with COVID, there was also something else that was going on. It was zero interest rates. So I think there was a lot of overbuying, a lot of technology that was purchased that really maybe was purchased ahead of its time. So we have seen in the last couple of years some rationalization of that. But when you zoom out, if you look at the big trends powering our business, is that identity is more important than ever, especially when you think about trying to secure and lock down these environments. You have to have a modern and integrated identity system to give you a shot to have a secure environment. And that's what we're doing. So big picture, these overbuying, underbuying will smooth out, and we're very bullish on the long term.
Todd, these announcements that you just made, do you think they're going to help you gain some market share here, pick up some market share from your competitors?
They're very important, and it's not only just gaining market share, it's really about solving the industry's problems. So we believe that if identity technology can better and more effectively and seamlessly connect to all technology in the ecosystem, from the phone you want to use to log in, to the computer you use at work, to all your applications, your IT group can make it all easier, your security group can get better visibility, it's going to make the entire pie larger. A lot of times when people think about putting in a new identity platform, they think, how fast is it going to be? How hard? How much work is it going to take? And by standardization, we can guarantee quick ROI to customers. And that's what they want, especially in this era where they're really making sure that all of their purchases are delivering value right away. The faster we can deliver value to customers, it's really a win-win for everyone.
Todd, we're marking the anniversary of last year's Vegas breach. I'm curious what kind of impact that continues to have on the business.
Well, every company is under attack. In fact, every month we block over 3 billion cyber attacks, from very, very basic credential stuffing attacks where a bad threat actor tries to steal your password and reuse it on multiple sites, to phishing campaigns and on and on and on. And so it's something that's very prevalent in the industry. And I think what we're trying to do is help companies understand how they can use our technologies in order to be more secure, but also how we ourselves are becoming more secure and hardening our own corporate infrastructure and working with our customers to champion best practice. We talk about it as our Okta Secure Identity Commitment, and it's really resonating with customers. They want to learn from us. They want to partner with us. They want to join us in this effort to standardize the broader ecosystem around standardizing identity security for everything. And it's a very good position to be in terms of the whole ecosystem being behind us.
Todd, always great to have you on the show and see you. Thanks for joining us.
Thanks for having me.
Coming up, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stick around, much more market domination still to come.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're looking at the pharmaceutical industry. There are a lot of names in the sector, but that might create some interesting opportunities for investors. So what's the best way to play it? I'm here with Salim Syed, Managing Director and Senior Analyst at Mizuho Americas. Thanks so much for being here.
Thanks for having me.
So let's get to the stock you like. It is Enliven. The stock's already done quite well this year. It's just about doubled. But let's get to why you might think it still has some room for upside. Efficacy and safety look good. Now, just to take a step back, Enliven is an experimental stage pharmaceutical company, so it doesn't yet have any drugs on the market, right?
Correct. Yeah.
But the drugs it's developing, you think, have good promise.
Yeah. So there's one drug in particular. It's called Enliven 001. It's for a type of blood cancer called CML. We have some phase 1 data that looks like rivals what people would consider standard of care, the newest product on the market. And it's also looks pretty good in terms of safety. So typically for something like CML, what you would want with these particular products is that they don't have any sort of cardiovascular toxicity, and they just put out 6-month or 24-week safety data, and it looked pretty clean. I think it's also important to point out that in this space in particular, there are a lot of these, they call them TKIs, that's the type of class that these drugs play in. But when you're talking about something like CML, which is now a chronic disease and people are living a lot longer, safety really matters. So having a clean molecule like Enliven and 001 really positions it.
Gotcha.
Well.
So in other words, the idea is not only to survive this type of cancer, but to live longer and live better.
Live better, and safety matters. And we've seen this before with other diseases like HIV, where this was often a debate with HIV, where it was the older medications, right? And it wasn't just like, hey, look, like if you match efficacy, it's not going to matter if you have something that's also safer. We saw a lot of patients roll over because those products were safer. That was HIV. So it's a pretty good analog when you kind of think about CML.
So that's talking about the drug, but let's talk about the monetary opportunity related to this. I mean, how big a market is this?
So CML has been growing. It's been around for some time, but again, these patients are living longer, right? And so they're on drugs for a longer time. It's now a $14 billion global market. We think it's pretty feasible that a product like Enliven and 001, even when you're talking about not getting, they call it first line share, the drug that's prescribed first, but even the second drug after the first line, right? Something in the order of 1 to 2 billion, 2 billion being more on a on-risk adjusted basis, 1 billion if you were to assign a probability of success because it's not through the clinical trials yet that it would need for approval, but 1 to 2 billion. So when we kind of think about that, and it's like, well, what sort of multiple would you like to put on a $1 to $2 billion revenue line? The stock is currently trading at $1 billion and change market cap. We think it's easy to start looking at this as more of a $2 billion, $3 billion story.
Gotcha. Even with the gains that you've seen.
Even with the gains that we've seen,
this year, and that sort of brings us to this: the stock is underfollowed, even with those gains. For example, full disclosure, I'd never heard of Enliven before you brought this to us today.
Sure. So we obviously talked to a bunch of investors. Enliven's one that we've been pitching for 2025. We think it's one that should be on the radar. But even in the institutional biotech specialist community, there are a lot of folks that are circling, that are in our inbox. They're doing work on the name. It's just, I think, a matter of time that we start to see more people come in.
Gotcha.
But on the spectrum, it is relatively underfollowed. So when you kind of think about new incremental capital coming into the stock, and that's obviously one of the things that could push stocks higher, we think that falls in that bucket.
Gotcha. Now, we like to talk about a potential risk here. In this case, it's pretty early still, so it's still in phase 1. What does the timeline then look like?
Yeah, so it's probably like a 2028 type of launch to revenue. So it's still in phase 1. We have 18 patients of data so far. So it's a relatively small trial, but again, it's a validated mechanism. These TKIs have been in existence for some time already. So it's not like you're playing with a new science, right? But it's just a cleaner product as far as we can tell. But we're gonna be getting more data in the middle of 25. That's going to be in about 60 or 100 patients, so a larger, they call it a phase 1B data set, a more mature phase 1 data set. That's really what I think a lot of investors will focus on.
And just quickly, because I want to get to the other stock, are there other companies that are working on comparable or competitor medications that could get to the market sooner?
Not really. I mean, there are others in this space. I mean, there's Terns, which I don't cover. That one's a little bit further behind.
Gotcha.
The one that people are looking at right now in terms of launch and sort of as an analog for what this market could be with a cleaner TKI is the one from Novartis called Semblix.
And then let's get to the stock that you don't like as much. You have a neutral rating on this one, and that is Amgen. Now, this one is very followed. It's one of the biggest biotech names. People know about it. The stock is up this year. It's up about 17%. But you say the intrinsic valuation remains difficult. Talk us through that. Why?
Yeah, I mean, look, this is one stock. When you talk to the biotech specialist community, it's very difficult for folks to get to a DCF valuation where the stock is trading. The stock is currently, $330 or so. Right, most people when they're looking at this on a DCF basis cannot get it that high and are nowhere close. Right, it's more in the 200s, low 200s type range. That's maybe mid 200s type range. That's sort of where people talk about it on a DCF. So it has sort of run away from that intrinsic valuation, which, look, as a fundamental, analyst, like it's one of the metrics we obviously look at, because the farther you get away from that, then you start to really wonder, like, well, look, if something goes wrong,
right?
Like what's the downside, right?
Well, and when we talk about what could go wrong, there's a drug that they are working on that is could enter the obesity market if it works.
Of course, yeah. So this product's called AMG 133. It's probably one of the largest, most followed catalysts remaining for biotech in 2024. We're going to be getting some data soon. It's for a phase 2 trial. The company has thus far said the drug is differentiated. Nobody really knows what that means, and there's really a lack of conviction, I would call it, amongst the investor community. But when you're looking at this in terms of where could the stock go, there's an argument to be made that the stock is going to 400, right? And that's very possible. There's also an argument to be made that the stock is going back into the 200s.
Gotcha.
Right. So for a large cap like Amgen, that's a pretty big swing. Yeah. It's also a year-end catalyst, so you almost have to play it if you're a long-only investor and you're trying to look at your benchmark. And I think right now people are positioned it sort of as a pair trade with Lilly, because Lilly is just obviously very owned given the obesity landscape.
And already has
Right.
So
exactly.
even if it works and it comes to the market, how is it going to compete with the likes of the stuff that's out there already?
Yeah, so it's a little unclear, right? I mean, we don't know, is it going to be a maintenance product? Is it going to compete with, Mounjaro, for example, first line, right? The dosing is, it's once every 4 weeks, so it does have that maintenance sort of component, but there's also questions whether that's something that's needed in the marketplace. There's also a huge capital, you have to manufacture all this product too, right? And that's a certain amount of investment. And then also Amgen has not been as close, obviously, to the relationships that you would need. Lilly and Novo, which came out of the diabetes landscape with GLP-1, and were able to transition more to that patient sleeve, right? It's a newer sleeve for Amgen, right? So I think there are certain commercial things to sort of take into consideration here, and of course they're going to be need to do additional study beyond the phase 2.
Things could go right. I mean, you talked about some of the, but also you said the company is good at messaging. So what does that imply? Yeah,
I mean, this company, look, the management team does well when they put out the data, right? They know what's going to make the stock go up and what's right. This is a company that it's hard to bet against Amgen, admittedly, right? We're neutral on the stock from a fundamental basis, and as I mentioned, there are ways that this stock can go to 400, and there's ways for the stock to go back in the 200s. But when we get this data set, and nobody exactly knows what we're getting, how we're getting it exactly, but this management team does message well, and that's something you do have to take into consideration, because if they say, look, we're going to take something forward here to phase 3,
right?
And you may not know exactly what it is. Does that mean like the PMs, the generous PMs in the market, do they buy that?
Right.
Right, because you're taking somewhere for, is that good enough?
Right.
Right, that's the question that I think people need to answer.
Well, not good enough for you to have it as a buy right now, but hold it is what you're saying. Thank you so much for coming in, Salim. Appreciate it. And thank you so much for watching Goodbye. We'll be bringing you new episodes next week at 3:30 p.m. Eastern.
Time now for some of today's trending tickers, and you can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, let's take a look at Lamb Weston Holdings. Nice move, 10% today. Activist investor Jana Partners saying it has built up a 5% stake in this one, wants the French fry supplier to think about some strategic alternatives. The stock, now it's popping today, but we know it's been rough in 2024. Jana says, listen, this company's shares, they are now undervalued. It talks about self-inflicted missteps that have led to underperformance for shareholders, Julie.
Yes, largest French fry distributor in North America. It sends its frozen French fries to companies like McDonald's, for example. So you have likely eaten, you definitely, and I definitely,
my daughter.
We have certainly eaten Lamb Weston French fries at one point or another. Jana is talking about potentially nominating people to Lamb Weston's board. It's working with the company's former executive chairman, a guy named Timothy McLevish, and they own about 7.1 million Lamb Weston shares. at this point. Now, the stock has really been struggling. Back in July, they came out with an earnings report that sent the stock tumbling by more than 20%, basically saying that demand was waning and they had an oversupply. And so, since then, it's really been struggling.
Yeah, so Jan is saying now it plans to have a talk with the board about names all kinds of different issues, share repurchases, management compensation, capital spending among them. And you can see, at least today, stock reacting.
Yes, definitely. All right, our next trend ticker is American Express. That stock is moving lower today despite the company announcing a third quarter beat on earnings, driven higher by year-over-year revenue growth. Sales did fall just a little shy of expectations, rattling investors. And the revenue miss is seen as a hint that even American Express's generally affluent cardholders are not spending money necessarily the way that they might be expected to. Steve Squeri, the CEO, saying on a call with analysts that they need to see things strengthen a little bit more to get to 10% revenue growth. He called it the right aspiration to strive for.
Yeah, I mean, stock's in the red today, but I mean, pull back the chart. This is one of those names that's just had a very strong year. It's up about 50% in 2024. The CEO talking to the press, sounding a very confident tone, how they've had 10 consecutive quarters of record revenue, really good quarter, the CEO saying, beat our own expectations in the street too. Today, though, we're dipping about 3%.
Yeah. Coming up, we're going to take a look at the best ways to be positioned in the industrial sector with today's Investor Playbook. Stick around, much more market domination still to come. The industrial sector hovering near record highs. And according to our next guest, there are pockets of strength that can run even further. And they might not be the traditional industrial names you might think of or even maybe you've heard of before. Joining us now for the Yahoo Finance Playbook is Jonathan Secreta, a CFRA research analyst. Thanks for being here, Jonathan.
Pleasure to be here.
Let's quickly just talk about industrials first of all and the strength that we have seen. You know, what's been driving that? And then now that we are in a rate cutting cycle, what does that imply for how they're going to continue to do?
Right, so a lot of it has been driven by those rate cut expectations. You know, going into the beginning of this year, we expected a bit earlier rate cuts to be taking place, but that 50 basis cut really was a catalyst to drive this sector forward. And as you said, last year the sector was up 18%. This year it's up 20% year to date. So there's really a high expectations looking really to 2025 as far as a recovery in sales and earnings growth and really a recovery in capital spending towards large capital goods like machinery and stuff like that. But I mean, with that, the flip side of it is that valuation has kind of gone up a bit, right? Multiples have increased. Right now, industrials are trading at 24.5 times forward earnings. This is a premium to S&P 500, a premium to its long-term average. So we think that it really would be prudent for investors to be a bit more selective in the space and be a bit more discerning as far as where they're allocating their capital.
In terms of, I know one big name that everybody knows, John, that you cover is Deere. You were on a hold. You cut that one to sell.
Right.
Was part of your thesis valuation there?
No, that was really a sub-industry call. It's really just a continuation in the deterioration of the fundamentals within ag and farm machinery, right? Like there's been record harvest yields across a number of different crops, and this has only helped to balloon supplies. Prices have suffered quite significantly. Now, last quarter, Deere & Co., it was pretty positive. They reiterated their profit guidance while peers cut it quite dramatically. But we think there's a high risk looking to the second half of this year that they're going to end up cutting it. Like prices continue to deteriorate, and while lower interest rates are going to be a tailwind, they can't outperform those lower commodity prices, right? At the end of the day, farmer incomes are decreasing, and that's going to hurt Deere & Co.
And now you also have this FTC investigation into their repair system and network. Is that a material risk, or it sounds like you don't think they're going to do well, regardless of the outcome of that investigation?
Right. We don't think it's going to be a material risk. Nothing existential for Deere & Co. This has kind of been a controversial point for them for a while now. It kind of comes and goes whenever it kind of enters the spotlight. But we really think that really the main thesis as far as to stay away from shares is just a deteriorating macro backdrop for farm and ag.
And Jonathan, Caterpillar, why is that a hold, and what would it take to get you more bullish?
More bullish. So Caterpillar is exposed to some favorable tailwinds. You have the power generation business serving kind of the backup power market for data centers, right? A lot of spending going into the AI theme. One of the, they want to make sure that backup power systems, Caterpillar really serves that role, but this is not a majority of their business. We're a bit mixed just given geographical exposure, right? The majority of their sales exist outside the United States. There's a lot of geopolitical risks right now in the Middle East, in Europe, so we're a bit more mixed on that. I'd say just clarity in the second half of this year, or actually the first half of next year really, that construction spending is coming back. Right, so non-residential has been kind of slowing down a bit. Residential has been slowing as well, but we'd like to see actually not just expectations, but like tangible results reflecting.
It's had a nice run, Jonathan.
It's had a great run. We had a buy recommendation. We had a buy recommendation, but then a 60% run from when we upgraded. We're like, okay, there's just less upside, right? And since then, it's entered kind of a period of volatility up and down, but we just need to see a bit more in terms of fundamental results these next few quarters.
So everybody knows Deere, everybody knows Caterpillar.
Right.
Let's talk about a couple of the ones people don't know. Let's talk Vertiv. Now, I mean, I think more people know it now than they did. The stock has had a crazy run. It's one of these AI-related plays. What does Vertiv do, and why do you think it's going to continue to be able to rise?
So Vertiv is a data center infrastructure play. So they are a leading manufacturer and service provider for thermal cooling and power management systems for data centers. Data centers represent just around 75% of their sales, but at the end of this year, we're expecting that to be more like 80-85, just given how robust this growth is. And if you look downstream from all of this, I really call it a spending spree from these large tech firms. If you look at Meta, Alphabet, Microsoft, Amazon, together they spent over $50 billion in capital spending just last quarter. Right, and where is this flowing downstream? You have companies like Vertiv that are extremely important in building out this this infrastructure, these hyperscale data centers that are going to enable these AI applications to really join the forefront here. Explosive growth. So first quarter, 60% growth in organic orders. Second quarter, 57%.
Sounds like NVIDIA.
Yeah, it's
Well, look at
kind
that
of,
stock chart.
Yeah.
It's a rocket ship.
it's done incredible, and you might want to hesitate thinking like, oh, it's doubled, right, since the beginning of the year. What's the catch? But really, the earnings growth is that substantial. It's not just a top-line expansion story. Look at margins. This was a sub 10% operating margin business. It's now going towards 20%. This translates into substantial earnings growth. This year, we're forecasting 45% earning EPS expansion. Next year, over 30%. And these projections are not even that bullish. So this is really one of the most attractive growth stories we've seen in the industrial sector for some time.
Quickly, what about XYL?
Yeah, Xylem. Now, Xylem is another infrastructure play, but really tied to federal stimulus passed all the way back in 2021. It's been very slow to work its way down to the project activity level, but we're starting to see some pickup. The Biden administration has worked very hard to expedite this IIJA funding towards the project level, about $550 billion of stimulus being dispersed out over the next few years. And Xylem is a water infrastructure play. Water technology, whether it's filtration, treatment, just the flow of water. This is really their bread and butter. They're a leader in this space. And we think there's a lot of upside here to go. It's really been an underlooked stock in our opinion.
Jonathan, that was great. Thank you for those picks. That was super interesting.
Of course. Thank you for having me.
Appreciate it. All right, let's check in on a few other trending tickers sponsored, of course, by Tasty Trade. Shares of Intuitive Surgical. Let's start there. They are ripping today after a third quarter earnings beat. So actually touched the highest intraday level on record per Bloomberg in today's trade. Company reports Q3 adjusted earnings per share. That beat. RBC, which likes the name, says, Julie, this was upside surprise on sales. They talk about driven by strong procedure volume growth, gross system placements. Target goes to 55.
Yeah, they make the Da Vinci surgical robot, and it's the DV5 that people are talking about. This is the latest generation, and most of the analysts, as you said, are lauding the uptake of these robots. Overall, the surgical system installed base is now over 9,500 of these systems. That's a 15% increase year over year, and it's a little bit above what analysts had been estimating.
It's had a big move this year. Most are bullish. No surprise after a move like that. Some more cautious. I reached out to Matt Taylor at Jefferies. Matt told his clients strong results, raised his number, raised his target, but still to hold based on valuation.
Gotcha. Let's talk Ally Financial. Ally shares going in the other direction here. This is coming after the company's pessimistic outlook as consumers are struggling to pay off expensive debts. Now, in particular for Ally, auto loans are in focus. And the shares are falling today, but they fell even more when the company recently gave a warning about its auto loan book in particular. Retail auto net charge-offs are at 2.24%. The CEO of the company saying that's going to get better, but nonetheless, it's something that investors are concerned about.
I remember last month, and I remember we talked about this, the company execs had called out sort of intensifying credit deterioration among borrowers. I remember us discussing that. I saw some analysts who were on the sidelines saying 2024 guide, updated with lower net interest margin, higher net charge-offs, lower tax rate. Stock has basically been flat here now.
Yeah, well, but you see there, obviously, the big leg down it took. One thing I should mention, they have been tightening up their lending standards to try to get things to improve.
All right, last one. SLB shares falling despite beating earnings estimates for the third quarter. So world's biggest oil field services provider, some look at this as sort of a bellwether for the oil and gas industry. Q3 earnings ex certain items that match expectations, sales less than estimated. But the headline getting attention was this warning, Julie, that oil explorers have kind of slowed spending growth recently among the lower crude prices we've been talking about.
Yeah, and in North America in particular, there's been sort of a slowdown in projects. There's been consolidation within the domestic oil industry. That's been one of the things that has taken down those number of projects. So that has affected SLB in turn here. So the company says that over the long term that they'll see this, what the CEO calls a sustained level of upstream investment in the years to come. It sounds like sort of the short to medium term, though, might not be quite as strong as investors had been expecting.
In terms of the big oil field contractors, Baker Hughes, Halliburton, scheduled to report next in the coming weeks.
Yeah, we'll see if they follow suit.
Yep. All right. While we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
There's the closing bell on Wall Street, and now it's market domination overtime. Let's first start with where the markets ended up on the day and on the week here, since, of course, it's Friday. We had the Dow little change today, up just about 37 points on the week, up closer to 1% here. So we've had this winning streak going on. And by the way, even though it was only about a 0.1% gain today for the Dow Jones Industrial Average, it means it closed at a new record because it rose to a record yesterday as well. The S&P 500 up for the 6th straight week. That is the best weekly winning streak of the year here. And it looks like it too closed at a record on the day. So let me count. I think we're at 47 in terms of the record closes for the S&P 500 thus far this year. The Nasdaq Composite not at a record, but positive on the week, and it actually led gains on the day, up about 0.6%. By the way, we talked to so many investors, Josh and I, this week who like small caps. Small caps had a little bit of spurt of activity earlier in the week, and they actually did better on a weekly basis, but fell a little bit on the day, down just about almost 0.2%. Now, I mentioned the Nasdaq, the best performer of the day. We saw communication services leading the pack higher, up about 0.75%. Netflix is in there. Netflix did very well following its earnings. Energy down the most today, but counterbalanced by some of those gains that we were seeing. And getting back to the Nasdaq here for a second, a lot of green among the Mag 7 here. Netflix finishing higher by 11% on the day. And just a quick look at that year-to-date chart as well. I believe this is a record close for the stock. But here, let's pull it back and check that out. Looks like we might have had a record for here for today for Netflix, a record close. And then we also have Apple rising on the day. We were talking earlier on that one with the one and only Dan Ives, who continues to like how he thinks the prospects for the iPhone 16 are going to look, which is been a little bit choppy in terms of sentiment surrounding that product, but up about 1.25% on the day. Josh?
Julie, markets finished the day higher. For more on the moves we saw this week and what to watch moving forward, let's welcome in Dave Harden, Summit Global Investment CIO. Dave, it's good to see you another day in the green. Do the good times continue, Dave?
Well, I think so. Thank you for having me again. Glad to be on your show again. But yeah, it's been good. Right now, we have credit spreads are really low. There's more than one job for everybody that's unemployed. Inflation is somewhat under control, or at least stable. We have the Fed in our back pocket. Besides the election, which we do have a date on that will end, and the Middle East, there's some clear skies that we could probably get some more returns in the future.
Given, you mentioned a couple of those things. I mean, what do you think is the biggest risk to those clear skies, Dave?
Well, I mean, the immediate risk is if we did see any change with the Federal Reserve, right? They were very accommodating, even surprisingly so, cutting 50 basis points in September. Everybody believes they're going to cut 25 basis points in November. So the reality is taking that punch bowl away would be a big risk to the market, right? So look at inflation, which seems great. Look at some of the risks on the play with unemployment numbers and CPIs and things of this nature. But right now they're in our favor. So if something changed there, that could change it. Another one would be right now, we understand what's happening with the election, which means it's just really tight. And so no one's really playing that bet. I don't see any real risk there whatsoever. To a large extent, but the Middle East is. There's no end date. We're always surprised by an attack or a counterattack or what have you. And this spreading from Israel to Gaza to Hezbollah to Iran to the whole Middle East, the entirety thereof, or the world, that right now is probably our biggest risk to the market.
Dave, what about the 10-year, 10-year? Any headwind to the stock market there?
Well, if you look at the 10-year, let's take a look at the spread between the 10 and the 2-year, for example. It was uninverted for probably the longest it has been for the last 40 years. And every time that spread actually steepens and gets, regular again, if you will, we see an inflation. We see a recession, excuse me. And so what is the Fed going to do different this time to prevent a recession? So the yields kind of indicate tough times ahead. And I would be very cautious. But the thing that the Fed did differently this time is they became aggressive. The Fed's been very passive. They've been very kind of behind the curve, some people say. They've been patient. Well, in September, they weren't. So maybe they are going to do something a little bit different this time. And maybe we will avoid that recession because a lot of indications is that we're not in a recession right now, and we're not going to go into a recession. So that's little thoughts on the yield curve.
So, Dave, as we are, you sound broadly positive. We're going into earnings here. What do you like going into earnings? For example, I know that you guys like Microsoft going into the numbers here. Have you been adding to positions as you sort of see some upside?
Sure. Well, the key here is I would say we're optimistic, we're positive, but you always want to have managed risk throughout your portfolio. If you don't know where your risks are and you're not managing to them, then you're really just gambling, if you will, right? So managing risk is the core of what Summit Global Investments does, and that's really what our clients hire us to do. And if you look at Microsoft specifically, this is a really good play into the Mag 7. It's a really good play into tech that's had a great run. But your downside risk, you have a real company here that has a lot of opportunity to make money within AI, rolling it out within Word, rolling it out within their different products they have and their operating systems. So I think that if anybody's going to maintain their current business and continue to have the profit margins and grow therein and capitalize on the future AI that's out there within tech, this is I think one of the plays that you have to be in. So we really do like Microsoft. We're excited about that position. And yeah, we're still looking to add where it's appropriate.
And just quick follow-up on that, Dave. There was some reporting today in the New York Times that the relationship and the partnership between Microsoft and OpenAI might be showing some signs of wear and tear, so to speak. Is that at all an area of concern for you?
Well, well, of course, in any type of distraction from the overall goal for a company is concerning. I think Microsoft has the power to probably go it alone if they had to. I don't think they want to. So hopefully that mends. And we definitely, there's always risk on the horizon. That's what people, I think, pay us for in the sense of to look at what's the risk now, not necessarily what's the risk yesterday. And so you're always watching now, the risk involved with stocks and what could make a stock go down is really, really important. So yeah, that is a concern. We'd like to see that kind of mend up and move forward. But in the other respect, I think that there's a lot of other really great AI out there besides just OpenAI.
One of the other things that you don't like when you talk about managing risk here, you want to manage the risk by staying away from Tesla, it sounds like, on the flip side.
Well, isn't it amazing what someone like, Elon Musk has done for the world, for us, for investors? It gives us so much to talk about, right? I mean, watching the SpaceX rocket come back down to launch this last week was just really amazing for most people. But the reality is that you never really know what he's going to do or say, what prices he's going to cut. And there's a lot of competition in this space. So Tesla specifically, we are not buying or we're not recommending that right now because I believe very strongly that if there's a case to buy it, Elon Musk is going to let us know. So because he's kind of a wild card and I don't know what's going to happen, I'm avoiding the stock right now, but I just feel very positive that when it's the right time, he's going to let us know and we'll go ahead and get into that stock.
We shall see, Dave. Thanks a lot. Have a great weekend.
Thank you.
Well, as we've been talking about, stocks are roaring and consumers are spending. Those are just some of this week's Bidenomics themes. For more, we're bringing in Yahoo Finance senior columnist Rick Newman. Here we are, October 18th. No October surprise. Or maybe the surprise is that the markets are doing great. I don't know, Rick.
Rewind just 3 weeks ago or so, and there were warnings galore of what an October surprise might be. Inflation might reaccelerate. Stocks are known to be very wobbly during election years in the October before election years. A bunch of other things that could have gone wrong. I just got my Yahoo Finance alert. Stock S&P 500 longest weekly win streak of 2024. I mean, this is like turning out to be the best month of the year. The economic news is good. The job market continues to be strong. And we saw retail sales numbers this week. Consumers continue to spend money. So one thing that is not going to surprise us is when election day does arrive, and it's coming soon, the U.S. economy is going to be sound. There could be other surprises, but the economy is in good shape.
Rick, a number of polls this week. I'm interested. Fox News, Marist, Marquette. Did we learn anything new there, Rick?
No, we didn't. In fact, it's remarkable how stable these polls are. And you'll see headlines that say Trump has overtaken Harris by a point or Harris is back up by a point. All these changes that we've seen during the last couple of weeks, they're generally within the margin for error on these polls. So this is really going to come down to, I think, a couple of key things. Turnout is going to be absolutely huge. And I always like to remind people we're talking about a small number of voters in those 7 swing states, which are Georgia, North Carolina, Pennsylvania, Michigan, Wisconsin, Arizona, and Nevada. So getting people out to vote in the first place is going to be huge. What we did see that was a little bit different this week is changes in the betting markets, which now say that Trump is up by like 15 percentage points, even 20 percentage points in some of them. Betting markets are not, those are not polls. And what those tell you is what people who are actually gambling money on the US election, what they are betting on. And they now seem to be betting more on Trump, which is why Trump's odds are going up now. There are many anomalies here. This is a thin pool that you can't even bet on candidates within the United States. It happens offshore. And the Wall Street Journal today had a story on one of the markets called Polymarket, in which they have identified 4 big traders, which could be one person. It's 4 accounts, and it could be one individual who is making a lot of trades. That person's basically a whale who seems to be moving the whole market with these big trades. So we don't know who that person is. That could be deliberate manipulation by a Trump ally to make it look as if Trump is gaining momentum, or it could just be an anomaly. But I would not put much faith in betting markets showing a huge skew here. This race is almost as close as it could possibly be.
Right. By the way, there is one place where you can place election bets in the United States, and that's on Kalshi, which is a prediction market that just recently got clearance from the CFTC and a court in order for people to sort of do yes/no bets on whether, and trades, I should say, on who's going to win the election. You know,
keep a little money in your pocket, everybody.
Yeah, right. You know, it's interesting here. I guess, you know, we struggle with the polls, with the prediction markets, whatever it may be, and their accuracy. At the end of the day, do we see polls having an effect on voter turnout? You know, and do we see people say, oh, well, this shows decisively so-and-so is going to win, so I'm not going to bother to go out? Does that happen?
I don't think that we know. It certainly could happen, but Julie, that's up to the camp. That's when what you hear this phrase in political campaigns called the ground operation or the ground campaign. That's where that's the job of the ground campaign in those swing states, in the counties, in you know, down to the individual zip code and neighborhood. It is the job of the Harris campaign and the Trump campaign to get people out and vote, you know, obviously for their candidate, no matter what is happening outside of what's happening on the ground there. The one thing I will add is the huge question in polling this time around is Trump going to overperform in the election relative to the polls, which he did in both 2020 and 2016. So rule of thumb is that in those 2 elections, Trump did about 3 percentage points better in the actual vote than he did in the polls. So if you apply that now, and Kamala Harris is up by 1 percentage point or 2 percentage points, but then you take away that 3 percentage point difference, then that suggests Trump is winning. But pollsters will tell you we have now accounted for that difference. We don't think it's going to be a factor in 2024 the way it was, especially in 2016 when the polls were the most wrong. Nobody's going to know until the votes are counted, and then we can see how they compare with the. But if it's not manipulation in the betting markets, that would be an explainer for why betting markets seem to favor Trump now, because the polls are down to 1 or 2 percentage points, and that would be smaller than the margin by which Trump outperformed before. So if he outperforms by the same margin, he will win. I'm not saying he will, though.
3.5 weeks is when we'll find out. Rick,
we're counting it down. Ben Werschel and I are now counting it down in hours for what it's worth.
Oh gosh, that makes it seem longer,
it's
though.
a little more than 400 by now, and on Monday it'll be less than 400.
Okay, I guess that seems better. Rick, thank you. Have a great weekend.
Bye, guys.
Coming up, Tesla faces a new investigation by the National Highway Traffic Safety Administration. We'll get you the details when Market Domination Overtime returns. U.S. auto regulators investigating Tesla's full self-driving software in 2.4 million vehicles. Our Subramanian is here with more. This is not the first time it's been investigated, but it seems to it seems to be ratcheting up.
Yeah, and this is a very interesting wrinkle here, because what happened is they're investigating 4 different FSD crashes with regards to situations where they had reduced roadway visibility. In one case, there was a fatality with a pedestrian. Another case, another injured motorist. So the question is, why is this happening? And this is kind of an important deal for Tesla, as we were discussing, Josh, earlier, about how the fact that their FSD system is vision-based only. It doesn't use sensors like other companies do, the radar and LiDAR, things like that. Purely vision. And if you have some kind of reduced roadway limitations, how can that thing operate in all conditions?
What are the examples of reduced visibility? Like, what are we talking about? Fog or?
They had 3 incidents. So they had sun glare, airborne particles, and then also fog, like you mentioned, fog. So these are things that happen all the time. I mean, I've driven before and had sun glare on me. So if you have a problem with vision-based systems, how do you explain then your robotaxi future? How do you have these cars going around without pedals or steering wheels and being fully autonomous if you can't see everything? So that's the issue. The Tesla stock didn't react that horribly today.
I want to ask you that, Braz. I mean, it's finished flat. So what is that? Is that investors assuming?
I think it's
what?
I think it's maybe they're confident that Tesla can kind of figure this out. Maybe they will add sensors eventually to kind of augment their vision-based system. But if you're Musk, the bet was on vision-based, because you can expand this system without having to map out every road and scan everything. It just sees like we do and drives. So that's sort of the issue. Maybe they think that this solution can be had relatively easily. So we'll see.
We will see, and we'll count on you to keep us updated. Thank you, Pras.
Thank you.
Appreciate it. Well, between 2024 seeing the hottest summer on record and AI data centers and crypto mining creating an unprecedented demand for power, energy companies are looking for alternative ways to meet those demands. And Texas, where power demand is growing faster than any other state, is right in the middle of it all. Joining us now is Pablo Vegas, Electric Reliability Council of Texas CEO, also known as ERCOT CEO. That's how people might see it referred to. Pablo, thank you so much for being here.
Thanks, Julie. It's great to be here with you this afternoon.
So you guys are seeing this rapid expansion in power demand. It has to do with crypto mining. It has to do with data centers. It has to do with population growth in your state here. And in the past, the grid management has been tricky at times, right? What are you guys doing right now to make sure that Texans have that stable power?
Well, the good news is we've got a pretty good history of driving and supporting this growth that's been happening in Texas. It isn't just in the last couple of years. It's really been going on over the last 5, 10, 15 years. The economy has been growing. The population has been growing. Now we're starting to see some of these larger loads coming in faster, like the data centers. And what we've been doing is we've been planning for this eventuality over the last several years. We are seeing tremendous growth in renewables on the electric grid. We've seen just since last summer an increase of more than 10,000 megawatts. To give you perspective how big that is, our total peak demand in the summer is about 85,000 megawatts. That was during the hottest period of last year. And so we've seen about 10,000 new megawatts of solar and wind and battery storage coming onto the grid. All of that is helping to meet the demand as we see this new type of load come on board.
Pablo, you mentioned renewables there. What does the mix of traditional and renewables look like in Texas?
So we're still largely a traditional generation resource mix here in Texas. The majority of what you'll see running the grid most days is going to be natural gas. It's the largest supply that we have. But so we've got about around 90,000 of traditional, 95,000 megawatts of traditional generation. And we've got roughly 25,000 megawatts of solar on the grid right now, about 40,000 megawatts worth of installed wind. And we're about 10,000 megawatts on the batteries. So when you add all those up on the solar and the wind and the battery side, you're not quite equal to the traditional generation yet. But that's the fastest growing component of the electric supply here in Texas.
Now, according to the Energy Information Administration, you guys are, there's a lot of projects in the pipeline for you to approve before the end of 2025. Are you going to get them approved in time to get that electricity to the grid quickly enough to meet that growing demand?
Yeah, absolutely. And we do have a very healthy interconnection queue. It shows a lot of stated interest in developing generation supply here. We do a couple of things differently in Texas than in other parts of the country. One of the things we do is a process that we call connect and manage, where when a generator wants to come onto the grid, we do not require, if there's the potential for any transmission level constraints for that generator, we don't require the whole transmission system to be upgraded before that generator can come online. A lot of other parts of the US do require that, and that's what can take so many years in other parts of the US to develop new power supply. In Texas, we go ahead and let that generator develop, and then if we have to curtail them because of transmission constraints, then we do that. And that's a known risk, but it's something that happens very infrequently. So developers are more than willing to do that in order to get access to the market more quickly, to be able to develop their power systems more quickly.
Is Texas, Pablo, in your opinion, is it faster than other states in meeting this challenge, meeting this demand? Are you able to act more efficiently, faster? Are you more nimble?
Yeah, we have a little bit of a lighter regulatory touch here. One of the benefits that we have, which is a significant difference than other states, is we're not subject to the Federal Energy Regulatory Commission for changes in our wholesale power markets. So the FERC oversees the wholesale power markets and the interstate transmission development for the 49 states outside of Texas. They do not oversee it in Texas. So that means we can make changes as needed. When we start to see, different types of customers coming on board, we start to see data centers coming on board. We saw when we had the significant winter event back in 2021, Winter Storm Uri, and needed to make some changes to improve reliability right away. The legislature here in Texas has the authority to do that. And then so the legislature can very quickly act. The Public Utility Commission can turn their laws into regulatory requirements, and then we can implement them right away. What could take 3, 4, 5 years at the federal government level, we can do in months here in Texas. So we are a little more nimble and more agile because of that.
And Pablo, the changes that you talked about came after you did have some issues there in Texas, right? So it sounds like you made some adjustments. So what advice would you offer perhaps to some of the other states that are grappling with things like climate change that are causing unusual temperature and weather events, that are seeing that increase in demand because of data centers, et cetera? What lessons have you learned that you would pass on to them?
Well, so being nimble on the regulatory process for interconnecting new generation supply is really important. So take a look at all the different administrative and red tape that's out there. See where you can cut that away, because there's, I think, real opportunities to eliminate some of the waste in the development cycle. The other thing I would really counsel anybody to focus on is balance. Balance is probably one of the most important things that as a country, and certainly in Texas, we're focused on this as well. But as a country, we need to focus on a balanced growth in the energy supply. We cannot turn our back on traditional generation sources like natural gas, because we are going to need to continue to serve the electric needs of a growing economy. And as you all know, there's probably nothing more consequential these days after air and water than electricity to support modern life and human life. So we need it to be reliable. It has to always be available. It has to be low cost. So we need to have a balanced mix of energy resources serving those needs across the country. And that's something we're focused very significantly on here at ERCOT too.
Pablo, I'm curious how much visibility, how much sort of line of sight you have into how customers and companies are using energy there in Texas, the data centers, the crypto miners, and everybody in between.
Yeah, we get pretty good visibility into that, because whenever a large customer is coming online, they have to pass a series of screens and studies to make sure that they can interconnect into the grid safely and reliably. And so anytime the data centers are coming online, or a large manufacturer, a steel plant, chemical refiner, anything, we have conversations with the transmission operators that are going to serve those customers, make sure that we get visibility to how they're going to operate on the grid. And so it's becoming more and more important, in fact, to have that kind of level of information, because as you can imagine, operating a grid where you have a lot of intermittent resources, so renewables, which can come and go based on the weather, you really need to be very responsive and agile to keep the grid in balance at all times. And on the other side of the coin with customers, Think about, customers that have rooftop solar, large industrial customers that can, change their energy demand based on the price of electricity. We need to be able to flex up and down very quickly and know what they're doing and how they're going to do it. And so that's of growing importance to us, and it's becoming a bigger issue around the country as well.
Pablo, great to have you on the show today. Thank you so much for joining us.
Appreciate it. It's good talking with you both. Have a great weekend.
You too. Time now for our options playbook, sponsored by Tasty Trade. We're taking a look at the bigger picture of the options market, which has seen 4 straight years of record volumes. Earlier today on Catalyst, CBOE CEO Fred Tomczyk joined Madison Mills and Shauna Smith about how popular options trading has really become. And they first asked whether the options activity is now being driven by retail investors versus institutions. Take a listen.
If you look across the option market, it's still more institutional than retail. What's happening more recently is you've got a little increase in volatility, which is causing trading. You've got more expirations, so we've introduced products to give you expirations every day of the week, so that's increasing volume because it makes it more efficient to hedge risk around certain market events that you may be worried about. But it's also because the retail brokers have introduced option trading and education to help people get comfortable with them. So it's the whole ecosystem that basically is growing right now. And it's not unique to the US, it's happening around the world. There's a lot of option volumes in India and in different parts of the world. People are using them to hedge a risk, generate income, or place a speculative position on.
Is the options market still just in, not its infancy, but early stages, given the fact that we've had 4 years of record growth or record participation? You're saying that there's a lot to remain optimistic about. When we talk about why investors are turning to the options market, what do you think that activity then looks like over the next 3 to 5 years?
Well, we've had very strong growth the last 4 years. A large part of that's been driven by what's called zero DT, the multiple expirations. There's no question about that. It just gives people a better way to do things in the short term, and it makes it less expensive. So I think that growth will moderate somewhat, but I think it will continue because you just continue to see the adoption in the retail brokerage community by those clients on the use of options. So I suspect growth will continue, although it will moderate somewhat from what it's been the last 3 or 4 years.
Fred, what's next for those short-dated options? What do you think will be the next big ODTE trade?
Well, that's hard to call, but I would say there's lots of talk in the industry about single stock options, trading in a zero DTE style. That's complicated for a lot of reasons in terms of physical settlement and the clearing systems and whatnot. So the industry needs to be careful with that to make sure the market's ready for that and the infrastructure is ready for that. But at some point in the future, I can see that happening. Whether that'll happen next year or not, I don't think so. I think it's going to take a bit of time for people to sort of work through the mechanics of that and build the necessary technology and infrastructure for that.
Fred, going back to the start of August when we saw that massive spike in volatility, when you take a look at some of the losses that day and those that were caught short-handed, I'm curious from your perspective, what was the biggest lesson you think investors or traders should have learned given that massive spike that we're seeing right there on our screen at the start of August?
Well, first off, if you're going to trade options, you have to stay on it. And what happened on August 5th was a unique event. Basically, when the Japanese market fell 12% overnight, the S&P 500 E-minis were trading down 5% pre-open. So you had a liquidity event where there was an unwinding of the Japanese carry yen, the yen-dollar carry trade. So we had a unique event with a lot of liquidity. So that did spike in that moment. But once the market opened and it normalized and came back, so sometimes you can just be patient and ride through that. In other cases, you need to stay on it. And in other cases, depending on your position, you don't want to leave it on overnight. So you want to close it down before you close for the night.
Given that, do you think that options trading is more of a avenue for gains for day traders than traditional, I don't want to say traditional investors, but more long-term dated investors? And what would you say to those investors who are like, this is just not for me. This is just way too time intensive.
I would tell you to take your education to learn how to trade options properly. And if you learn how to do it properly, you're going to start with generating income. You're going to sell covered calls, maybe cash covered puts. So you're just generating an extra yield on an existing portfolio. So that's the first place to start. And then if you're going to migrate up, you migrate into spreads and defined outcome trades. So when you place a trade on in the option market, 2 lessons are always know your downside and make sure you're protected and you're comfortable with it. Secondly, if you're going to trade options, stay on it. It's not something you put on and forget like a stock for 5 years or so. You have to stay on it every day. If you do those 2 things, your odds of success improve significantly.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that is going to move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. And here's some of the trends we're going to be diving into. The Dow and S&P closing at new all-time highs. Again, the S&P extending its streak of weekly gains to 6 in a row, and that's the longest of the year. It comes as earnings season ramps up, and we have a look at what you need to be watching next next week to make smart moves for your portfolio. And a look at how AI and new technology are disrupting the business of hearing aids. I'm going to be speaking with Shark Tank star Damon John and the CEO of one of the top companies in the space to learn more about this trend and how big tech names, including Apple, may be stepping in. Plus, betting big on women's sports. We have one investor who's backing the WNBA, and we're looking at where the growth and opportunities are. Now, artificial intelligence is everywhere, and companies are constantly looking for ways to incorporate AI into their businesses. But if you listen closely, you might just hear about a company using AI to revolutionize the hearing aid industry. And joining us now is Starkey CEO Brandon Sawalich and Damon John, Fubu and Shark Group founder and Starkey ambassador. Gentlemen, welcome to you both. Damon, I want to start with you.
Hey.
In your own life, Damon, you had a range of hearing aids. You could have chosen. You chose this one. Why Starkey?
Well, I really didn't know about the value and how great hearing devices and amplification devices were until I actually started working with Starkey because of their Starkey Hearing Cares, where they were giving away so many amazing devices to people in need. And then I started to understand that I needed them myself. And this relationship started probably about 10 years ago. And as the relationship grew, the technology and the AI and everything else grew. And I didn't only need them when I felt for hearing. I felt that I was getting the edge now on other people with the language translation and the way to have things streaming to me. So now they're way more than something that I just use to amplify hearing, which is probably the most important part. But now I can use them for so much more.
Brandon, I want to get you into the conversation as well. Walk us through, Brandon, what makes your product different? What's the competitive advantage?
Well, I think we're thinking differently. We're taking, we started this journey 7 years ago. Edge AI is a lot of hard work for the last 7 years of bringing AI and advanced technology to hearing aids, where we're redefining hearing aids and, eliminating the stigma of what hearing aids is. It's not about amplifying sound. You have a mini computer inside your ear, where basically the ear is the new wrist, and helping people be the best selves they can be each and every day.
And Brandon, there was an interesting piece in the New York Times recently. I don't know if you saw it, but it went into the role Apple could play here and how consumers are going to be able to use Apple's AirPods Pro 2 earbuds to bolster their hearing. I'm curious, Brandon, what do you make of that? What could Apple stepping in here? What could it mean for your business? What could it mean for the broader market?
Well, our hearing aids connect with Apple devices. So we work with Apple in a different function, but I think it's great because you have, 44 million people with hearing loss, low penetration because of the stigma, a tech giant like Apple coming into our, announcing and talking about hearing aids, it helps the conversation. It starts making what I think hearing technology being cool. So they're a tech giant, and I applaud them.
Damon, it's curious. Brandon mentioned that word stigma there. I mean, do you also believe that there is a stigma still attached to the traditional hearing aid?
There's a massive stigma attached to it, and it's absolutely wrong. When you think about it, 30 years ago, we talked about, we gave people, there was a stigma if you wear glasses. Now it's how cool your glasses. Watches were to set time. Now today it's to measure things. And we are walking around with these, but, I can sit in a meeting with these, and as Brandon says, if I have both of these in, you're going to get mad. You're going to say this person doesn't care about me, right? So take that out. But now, all of a sudden, look, you wouldn't be able to tell that I have this. Why do I have these? So I think the stigmatism is false, and I think that it's a narrative that needs to be changed because we're walking around with forms of communication in our ears, but this one can let you hear some music. This one can tell you if your parents fall or not and send you messages and translate languages. So these are just so much more advanced, and I think this is where we are going.
Brandon, what about the process of securing hearing aids? How has that changed over the years?
Well, I think, there's a lot of different forms people can get hearing aids. You're seeing your audiologist, your doctor, really with hearing healthcare, as Damon mentioned, and Josh, I appreciate the interest on this because, more and more people need it. And you have your local audiologist, your healthcare provider, different forms where it's really going away from, hearing aids to hear tech. And it's your personal assistant. And people, what it does, it's that word hearing aid. it's really your personal assistant. And that's what we got to look at is it's going to help people do more for society, be the best they could be, in their job and for their family. And it's not just about being old, it's getting back in the game.
And Brandon, for people who aren't aware, I mean, your company's been around a long time. How big, Brandon, is the market you're addressing here, and how fast is it growing?
Well, it's growing, very quickly. And the less the stigma, the faster it grows. There's, 5 hearing technologies in the world, companies in the world, and we are the only U.S. owned and operated company. And, we're growing, since we've launched and introduced AI and more technology over 50%. We're doing great, and to me that's not about the numbers of the revenue. We're in the people business. We're helping people, and that's the way I got to look at it, and the way I look at it with each product and product technology we come out with.
And Damon, you're a Starkey ambassador. When you think about what got you invested in the company, I mean, was it the company, the people, was it the business model, was it the tech?
Well, first of all, I thought the company was amazing, but then I started to realize it takes 10 years for somebody to realize they even have hearing loss. And the amount of conflict in my life and other people's life that reduces when you realize that you were having arguments and challenges because you actually didn't hear the people correctly, and that how it helps, prevent the things like Alzheimer's and things like that nature from people, shunning away from crowds. I found it amazing, but I also, I am who I am because I want to surround myself with the best. And I consider Brandon, I consider him the Steve Jobs of this area. When Steve was talking about computers, he was talking about how technology is going to change everybody, not just what's in a computer. And I find that it's a reverse mentorship. So, I don't learn anything from my fellow sharks, but I need somebody to learn something from. So, I go to Brandon when I want to know about technology, and I consider this guy the leader in this and a groundbreaker. And so it's a symbiotic relationship. I'm enhanced here and my powers here, and then here mentally I get to learn from the one of the best in the business, or the best as far as I'm concerned.
Damon, I correct me if I'm wrong, but I think the new season of Shark Tank, I believe, premieres tonight. So I am curious, while I have you, beyond Sharky, any other trends, themes, Damon, that you're curious about right now, that you're particularly interested in?
Yeah, it is just like starting democratizing various things and information, and it's the way that we are, the everyday consumer is now utilizing information from the AI perspective. I think the walls are broken down. I think if you want somebody to make newsletters or create be a secretary for you, I think these consumer type of goods are their AI, or whether it's Elon Musk saying, I'm going to have a robot, clean your home. Or I think that I'm really excited about all the new technology and how the everyday entrepreneur and person are putting those things to use. So that's really, really exciting because it's no longer, make it and they will come. The people are now have the power to make that change.
Damon, Brandon, thank you both for your time. That was a great conversation. Enjoy the weekend.
Thank you, Josh.
And coming up, the WNBA could be crowning its newest champion tonight, but investors behind the growing league have been winning all season long. We're asking for a trend right on the other side. The WNBA could have a new champion tonight with the New York Liberty on the verge of their first title, taking on the Minnesota Lynx in Game 4 of the WNBA Finals. However, the WNBA is already a big winner this year. Regular season viewership up 170% compared to 2023. Playoff viewership up 142%. And Game 3 of the Finals averaged 1.4 million viewers, making it the most watched WNBA game of all time on cable. Many investors believe the league and women's sports in general are only just getting started. And joining me now is Justice Palmer, Fortuna Investments CEO. Justice, it is good to see you. Maybe to start high level, Justice, you're a VC, a venture investor. You could have put money to work in any number of sectors, industries, verticals, companies, but you're interested in women's sports. How come, Justice? Make the investment case for us.
Well, that's just it. And so thanks, Josh, for having me. And we've been very active in many different sectors, such as clean energy, battery technologies, the space industry. We've done exceptionally well. We've had a great track record in all these emerging areas and industries. And when it comes to sports is also an investment. It's a very unique asset class. And again, so you've got the big four men's clubs. Those are kind of the blue chip stocks of the portfolio. You've got men's baseball, men's basketball, men's football, obviously, and NHL hockey. These clubs are $5, $6, even $7 billion in value. And so those are blue chip stocks and blue chip assets. They're very, very unique. And so when it comes to women's sports, it's much like I don't want to say a venture or a growth investment, but some people think it's underrepresentative. There's only 5% of Fortune 500 companies that advertise in women's sports. I actually think that's a huge opportunity. The ceiling is so high for this, and relatively speaking, the buy-in is actually significantly cheaper. So it's a great time to be alive. It's a great time to be an investor. It's a great time to be looking and backing some of these unique companies and assets and individual players and teams, because the sky literally is the limit for them.
And Justice, why then the WNBA specifically there? And how are you investing there? Are you investing in the teams? Is it the infrastructure behind the teams?
Yeah, it's a great question. And so the a couple things, right? And so women's sports is a very broad playing field, right? And so the WNBA in particular, it's got a lot of unique advantages and things going for it these days. Number one, it's owned majority by the NBA, over 50% owned by the NBA. So it's got the backing of big brother or big sister. It's not going anywhere. It's here to stay. So I think that's a really good point and attribute. And it carries a little bit further than that too, because when they're negotiating TV rights and corporate sponsorships and things like that, it's actually quite nice to have the power and the backing of the NBA. I think obviously at some point in time, if things go the way they may go, there may be a little bit of a divergence, so they're still not lockstep and barrel together, but it's a really good thing to have that sort of backing behind that and that muscle behind it. And so that's point one. Point two is, so myself and a group of backers and investors were actually bidding and backing on one of the expansion teams that are looking to come to market, team number 16, which will be playing in the 2027 season. We're very, very optimistic about our bid. We love the city that we're backing. We think it ticks all the right boxes. For obvious reasons, I can't get into too much detail about what that city is and what that looks like, but we're set up really, really good, and I think the future is extremely bright.
We should mention here, Justice, Yahoo Sports has its own women's sports portal just for viewers. But another question I had for you was, one, Justice, how much capital are you deploying here? And two, when you talk to your LPs, were they as excited as you are?
So, a couple of things. So we run actually as more of a family office where it's our internal capital, it's our partners' capital. When we make these investments, they're more atypical, like SPV type of investments. So we'll put our own money up. Initially, we were looking to deploy $50 million. We've actually gone up to closer to about $100 million that we're actually looking to deploy at the current moment. So we've got capital, we've got a big rack. We've got some great external partners, some very name brand folks, household names that you may know of, who have really taken a liking to what we've been doing. The future's really bright. We're getting this all put together. I think we're still very, very early days, and it's an exciting time to be in this arena.
And Justice, quickly here, it's the WNBA now. You think down the line, are there other women's leagues you'd be curious about?
Absolutely. I mean, and again, it's such a broad spectrum, right? So you got to start somewhere. You can't do everything and anything. The interesting things is there's PE firms that are sprouting up. They're totally dedicated to women's sports, like Monarch and a bunch of these players. So it's a very broad arena. We ourselves are starting in the W. We like to start in the WNBA. The women's soccer is taking off. If you take a step backwards and go back to the Olympics, for example, women's gymnastics was the #1 draw out of any sport, men's or women's, right? So the viewership is there. When the viewership is there, the fans show up. The fans have extraordinary voting and political capital, and then the corporate sponsorships generally show up. And so that's kind of the trajectory. But I think across the board, bar none, I think there's a tremendous amount of room to grow. These women, and again, this is not I don't want to say charity endeavor or DEI type of let's empower these people for the sake of doing it. These women are extremely talented. The games are, I don't know, Josh, if you got a chance to watch some of these games. I know it's Game 4 tonight. Maybe the Liberty close it out at home tonight. Maybe that goes to a Game 5, which would be very exciting. But these are extremely, extremely exciting things, and it's drawing a lot of fans in. And my last point is, I've got a lot of friends in New York. I'm down here in Miami, and some of my friends tell me, and these are wealthy guys, hedge fund managers and folks like that. They're saying, hey, I'd love to take my family to the Knicks game. It cost me, between the 4 tickets, popcorn, booze. I'm into this thing for $2,000, $2,500. I can't do that every single Sunday. And so the value that you're getting, with the Liberty and things like that, you can take your whole family for a couple $100, have a fantastic game day experience. It's a no-brainer for me.
Justice, super interesting conversation. Thank you so much for sharing it with us. Appreciate it.
Pleasure's mine. Thanks, Josh.
And coming up, it's What to Watch for Monday. I'm going to tell you everything you need to know to kickstart your trading week. Stick around. We're asking for a trend right on the other side.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains, where for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Time now for What to Watch next week. Starting off on the earnings front, a lot of big names reporting next week, including Coca-Cola, GM, UPS, and the first of the Magnificent Seven stocks, Tesla. It has been a busy month for Tesla, company reporting third quarter deliveries, which came in above estimates. And of course, the results come on the heels of last week's robotaxi event, which was a disappointment for investors. Taking a look at the Fed, we're going to be getting some Fed commentary throughout the week from Fed Presidents Lori Logan and Patrick Harker. It's coming after comments this week from Fed Governor Christopher Waller suggesting a more gradual pace on interest rate cuts going forward. And moving over to housing, monthly home sales data coming out next week. Economists forecasting existing home sales to tick up to 3.88 million and new homes to hold steady at 716,000 for the month of September. That is a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.